It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and I don't know if you know it, it is April the 4th, and 4 from 15 means 11. 11 days left till the end of tax season, and if you're one of those procrastinators, or you're getting letters and you don't know what the heck to do with them from the IRS or State of New York, EG Tax will help you. All of our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday, and our McKinley Mall office is open on Sundays. And this is Chris Fabian. We got him out of the office.
Hello, Esther.
Hello, Christopher.
But they're not open this Sunday.
Not because it's Easter.
It's Easter.
And I hope everybody has a wonderful Passover and a blessed Easter. And last night, my last client at 8:30, he says to me, "Do you think we just committed a sin together?" And I thought, holy moly, I must have missed it. I must have missed it. What do you think what did we do? He said, "We talked about money on the day that Jesus was crucified." And I said, well, he wasn't crucified today. It is Good Friday in remembrance of that. And I think that we're good.
Yes, yes.
It was so good. It was so good. Anyway, I'm Esther Gulius, the Tax Lady from EG Tax. If you have any questions, we would love to help you. 803-0930, 803-0930, star 930 on the cell phone. And for those of you in Toronto or Arizona or Florida, our toll-free number, and Jay gave me the right phone number, is 1-800-616-9236, 1-800-616-9236. And I know we got people that are going to be calling in, but we wanted to talk about, this is a mystery. If you're somebody that has a brokerage statement, and you look at those things and you say, every one of my clients say, I do not know what this thing means. We thought we'd explain your brokerage statement so to make you very, very smart.
Right, because it is. It's one of the most confusing. That's where a lot of people's money are tied up right now, and they don't know how to read it.
And they don't know well, first of all, one of the things on your brokerage statement is interest, right?
Yep.
Now, on your brokerage statement, there's taxable interest and there's tax-exempt interest. But your taxable interest is pretty easy unless it's interest from a U.S. From a federal obligation.
Correct.
Why would that be important, Chris?
Well, because it's taxable on the federal, but not New York State.
So you'd have to remember to back it off on New York State. Now, and many people are in tax-free, have tax-free interest.
Tax-exempt.
And tax-exempt interest. But what do you have to do when you're looking at that brokerage statement?
Well, it's tax-exempt. I don't have to report it, right? Wrong.
And it's wrong because of two things. First of all, because it's tax exempt on the federal, but it may be taxable on New York State. Because you have to, when you're looking at your brokerage statement, you have to go back into the back part of it and make sure if you're in New York State that they're all New York State municipal bonds, because otherwise you have to add it back on your New York State return. And on your federal return, you have to list it because why?
It could affect your taxability of your Social Security.
That's exactly right. So that's the first thing you want to look at. Second thing is many times on that, when they're giving you your dividends, it has something that really alludes to non-taxable return of capital. And so this is really important because your return of capital means that they're giving you back basically part of what you paid for the stock, and it adjusts the basis of the stock down.
Correct.
Right?
Yep.
So you want to make sure that you're keeping running totals of any dividend that you're getting where it says it's a return of capital, because that means in essence they're giving you the money back that you paid for the stock, and so your basis goes down.
Yep. I had a client the other day, and he goes, "Yeah, this is really great. I invest in this one energy thing, and I get this non-taxable dividends. That's really great. I don't have to pay tax on these dividends." And I said, "Well, that's because it's your money." "No, it's not. It's the earnings. It's called dividends." I said, "That's your money coming back. It's a return of capital." Oh. So you got to really understand where your money is.
And that's the other thing. I had a client last night that we were looking at. He had sold some stock, and we're going to get to this a little longer. But it was uncovered. It was uncovered stock long term, which means that the broker is not providing you the cost basis, and it's up to you to report it, to find out what it is. So it happened to be his child's stock that was sold, and that meant that the kid could have kitty tax because it was around $8,000. And I said, now what you need to do is, if you won't go and research this, the kid's going to end up with kitty tax, paying at your rate, and it's not good. And so I said, it wasn't the Tooth Fairy that left them the stock, right? I mean, you bought it. So he said, yes, well, look, I got this big thing full of, this is what I paid. I said, you got to add up all of what you paid for it, plus your reinvested dividends, and that gives you your adjusted cost basis. And why would we do this? Because it saves you money. Right?
Money.
All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on cell phone, and we got Ed, who has been waiting. Hey, Ed. Wow, that's loud.
Hello, Esther.
Are you like drilling something in your garage?
Oh, I'm shredding tax documents from 1971.
That's a good guy. Shred those things, boy, Ed. It's interesting. We were just talking. I had a client yesterday came in from Rochester, and Chris said, you know what, we should have a shredding day. And we'd bring in a big shredding truck, and all the clients or anybody that listens to us can come and we'll just do hot dogs in the parking lot if it ever turns summer, and we'll just shred documents. So there you are, shredding documents. So what can we help you with?
Okay, a friend of mine was losing their house to foreclosure.
Okay.
They came to me and they asked if they could borrow $15,000 to save their house so that they could sell it because they had equity. And I lent them the money. Mm-hmm. They filed bankruptcy on me.
You just wrote me this question, didn't you, about an hour ago?
Yes, I did. I don't know if you responded yet.
I did.
Oh, okay.
So here's the deal.
See the response.
See, I'm the one who answers all the tax questions. So
okay.
I wrote you back. First of all, it has to be a real debt. It can't be like a handshake. It can't be like.
Oh no, it's written.
Yeah, okay. Well, if they wrote it off in a bankruptcy, it would have to be.
Right. Well, not necessarily. All you have to do is list it as a debt. But I mean, all right. And did you do anything to try to get them to collect on them? Legally?
They made a couple of payments, and then they stopped.
Okay, but what did you do when they stopped? Did you go after them legally?
I didn't. No, I didn't have time because all of a sudden I got a phone call.
Okay.
I just filed bankruptcy.
Okay, that's all right. So you didn't have you didn't have time to go after them legally.
Well, I suppose if I jumped on it, within a couple of months, but they kept telling me they were going to pay me back.
Right, that would be the only fly in the ointment. Is that you have to, in order to do the bad debt. Okay, you have to. The IRS is going to take the position. These were your friends, and it was more like a gift than it was a loan. But and that's where it's really important that you write down as best as you can what you really invested in time and I talked to them on this date. I talked to them on this date. Here's a copy of the letter that I sent them, so that it can be established that this was truly a bad debt. And if it is, then Chris, they write it off as a
Schedule D.
Short-term.
Yep, and you get $3,000 a year unless you have other capital gains to offset it.
Right. I mean, it sounds to me like because they listed in the bankruptcy, these are obviously not your friends anymore, correct?
Obviously.
Yeah, that's so sad.
Yeah, it's too bad. It's people that I knew for 30 years.
That is so sad.
Yeah.
But anyway, well, so you would end up with, it sounds like you really do have a bona fide bad debt, but you want to make sure that you have as much information available if they come after you that you can prove it, okay?
Yeah. Now, you're saying I can't write it off all this year. I have to do the $15,000 and then $3,000 with a $12,000 carryover.
That's right. Well, but you can offset it with other capital assets. In other words, if you have a stock portfolio with capital gains, you can use that $15,000 to offset your other capital gains distributions.
Right, but the maximum I'm going to be able to write off this year then is when I get to the bottom of the Schedule D, it's going to be $3,000, and that's going to be it.
That's it. Yep.
Okay.
All right, Ed.
Thank you very much.
Ed, I could use some money.
If you're in foreclosure, give me a call.
Thanks, Ed. Bye-bye.
Okay,
Happy
bye.
Easter. Oh. I'm Esther Gulius, the tax lady. 8030930, 8030930, star 930 on a cell phone. Out of town, 1-800-616-9236. I'm Esther Gulius, the tax lady from EG Tax. We're going to take a short break. See you on the other side. You know who's coming to town?
The Easter Bunny.
No, well, that's true too. But the Rolling Stones. And I was telling Tyler that I got my husband. I said I want to go see the Stones concert, and he says I don't understand why. Anyway, thank you, Tyler. That was the Rolling Stones. I like Stop Me Up. Anyway, actually they are not a lot older, but they are older than me because I used to listen to them when I was a kid. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we're from EG Tax, and we only have 11 days to the end of tax season, and EG Tax is going to help you. And I'm going to tell you, you can come in as disorganized as you think, or you haven't filed multiple year returns, and we will get you done and get you done on time.
Yep.
Right?
Yep. We had a gentleman call today. Yeah, my girlfriend comes there and says I have to get my taxes done for 3 years, and I owe the IRS already all this money. Can you guys really help me? She says you can.
We really can.
We really can.
We really can. I mean, we really are in there for you, I'll tell you. We wanted to talk about reading your brokerage statement while the calls come in here. Another part of your brokerage statement is your dividends. All right. Now, everybody knows a dividend is like the money that is sharing in the gain that a company has when you have stock. Now, what's important is that there's like 2 columns on the dividends. It says ordinary dividends, and then it says qualifying dividends. Why is that important, Chris, that you would deal with the qualifying dividends?
Well, first of all, you got to understand the qualifying dividends are already included in the ordinary dividends.
Right.
That's the second most important thing is the qualifying dividends are taxed at the reduced rate, at whatever your capital gains rate is. So if you're in the 15% tax bracket and you have capital gains of $5,000, you're not going to pay any tax on that 5.
Right, if you do the computation using the Schedule D.
Yep.
But if you're somebody that says, oh, I just can't do this, it's too hard, I don't want to understand it, and you ignore this, you'll pay it at your regular rate.
Yep. So, so that could cost you a 15%, $750.
Right. So then there's the qualifying dividends, and then the other thing is many times you'll see on the brokerage statement it says foreign taxes paid. That's a big deal, isn't it?
Yep. I mean, that's a credit. That's not a subtraction from income. It's a credit against your tax liability.
So you use Form 1116, and let's say you paid $300 in foreign taxes as part of your mutual fund, okay?
Yep.
And they paid that foreign country the taxes, and you get the credit. You actually, if you miss that on your tax return, and it was $300, you overpaid by $300 because you have a refund coming of $300.
Yeah, it's huge. I mean, very important, very common. People who have Manulife stock, the life insurance based out of Canada, there's foreign taxes on that. So.
Right.
There's a lot of different ones that have.
And many brokerage accounts have that. Again, if you don't know how to read it and you put it down incorrectly, you shoot yourself in the foot. We actually, I've had these conversations with my clients, which this time of year, many people are coming in with their brokerage statements. And I said that we'd be willing to do like a workshop, and you kind of would bring your Dean Witter statements or your next financial statements in, and we would actually sit there and tell you what it's saying, because this is a bunch of information, right?
It's huge.
I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Ben. Hey, Ben, how you doing?
Hello, Esther. How you doing?
I can't complain. What can we help you with?
For starters, have a happy Easter.
Happy Easter to you.
Okay.
People call me...
I'm totally confused
Yes.
about a couple of things.
Sure.
Number one, I am on Social Security disability because I suffered a broken back at work.
Oh.
Yeah, it's terrible, but that's beside the point. When I filed for Obamacare for my wife's insurance, because I had a plan, the cheapest one you could get for myself for catastrophic stuff, and also in the VA because I served in the military for 7 years. Now we file our taxes, and they're telling me that I owe the state $3,000 almost, and that the subsidy my wife got towards the insurance all has to be repaid.
All right, you mean you owe the federal, not the state.
Or, I'm sorry, the federal.
Okay, and that's something very important. When people were applying for Obamacare, and I have to tell you that many of the navigators really didn't know what they were doing, calling everything the way it was. They gave people subsidies that they shouldn't have given them. And then when you kind of do your tax return, it's kind of the rubber meeting the road, and that's where the real numbers are. And if you got a subsidy that you weren't entitled to, then you have to pay it back.
How do you determine whether or not you're entitled to it or not?
Well, let me ask you this, Ben. How much of the subsidy do you have to pay back? Is it all of your balance due?
Just about.
Well, then we have some
good.
good.
About $82 off a month.
Okay, but we got some good news for you, Chris. Tell him.
If your balance due is caused because of the repayback of the subsidy, this year the IRS is waiving that. So what's going to happen? You just send in whatever. Send in your return. They're going to mail you a bill. Come see us. We'll respond, write a letter saying, per your IRS law, regulation, this is not, we don't have to pay it back, and they're going to waive it.
Is that right? Now, I had my tax company, or a guy that we've been doing taxes for 20-some years. When we went to do this, I can't think of how they called it, this Obamacare thing.
Yeah, uh-huh.
We went to see one of the people at one of your offices because I could not get this thing I couldn't figure out how to do it. Mm-hmm. I kept coming up with mistakes. Mm-hmm. And the guy was super. His name was Tim. I won't go any further than that. You know what I'm talking about.
He's our navigator, yeah.
Yes. And at the time, he had to call a navigator because he didn't know. And based on my wife's income, she only works 2 days a week. She's self-employed. Came up with this thing about $82 a month. So I said, okay, fine. We didn't know that we'd have to pay it back. Otherwise, we'd have paid it up front.
But you see, your wife must have made more income this year than was projected, because the only time people have to pay it back is if they had overestimated their income.
Okay, but if it was overestimated, I think between
underestimated. So, underestimated their income when they applied.
Maybe $1,000 at the most.
Pardon me?
The difference between what she made last year and this year was maybe $1,000 more.
Okay.
My question.
All right. Now, here's something that worked the other day for one of my clients. If you put money into an IRA, that reduces your adjusted gross income, and many times that gets you out of the premium payment. You know what you should do, Ben, is if you would fax me over your tax return or email it and scan it to me, I'll take a look at it and see if we can't figure out a way around it. But as an ace in the hole, they did come up with a stipulation that if you have a liability this year based upon a repayment of the premium tax credit that you got, of the consideration you got from Obamacare, they will waive the payment of the liability, but they're going to first bill you, and then you have to request it. But if you want to, in the meantime, let's see if we can't figure out a way to get this thing reduced for you.
Well, I haven't gotten the statement, my taxes back yet, because the lady that's doing it was pulling her hair out trying to figure out a way to do this. And I had told her to call Tim because he helped us fill it out.
Yeah.
At this stage of the game, the long and short of it is, she says we still got to pay almost $3,000.
Well, you know what? I mean, when you get it, you'll get it before the 15th. You get it over to me, and I'll take a look at it for you. Okay?
And where are you located?
Well, let me give you my fax number. You ready?
I don't have a fax machine.
Okay.
I don't want to work.
Just go to our website, and I'm at the corporate headquarters on Niagara Falls Boulevard. Okay?
Okay. Well, that's where we were. Now, is my Social Security disability taxable?
Possibly, if your wife made enough income.
Or you have other retirement income, or
She's working, but she only made like $14,000.
Well, you know what, Tim? I mean, Ben, we can talk about stuff I don't know without looking at the tax return. I can't tell you, but I will tell you if you use the IRA in your right now, and you can do it up till April the 15th, all your problems can be solved.
Sounds very good.
All
I
right.
appreciate your help.
All right,
Do
thanks,
I ask
Ben.
for you personally, or?
Yeah, I'm
okay.
there.
You're on Niagara Falls Boulevard.
Right.
What's the address?
2475.
That sounds terrific.
All right, thanks, Ben.
Thank you very
Happy
much.
Easter.
Bye.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax. You know, I mean, it's not like I'm evading. I just don't know what he's saying.
without looking,
Right.
it's too
But
hard.
I'm going to tell you, if you use the IRA as
It will
a way to
reduce your income.
right, and that could get rid
Yep.
of it altogether. But what we told you is true. They will waive it. So let me go to Rich. Hey, Rich, how can we help you? Hello.
Hello.
How can we help you?
Esther, I'm on Social Security disability,
Uh-huh.
and I have an opportunity to work.
Okay.
How much money can I make before I affect my Social Security?
Okay. Well, are you single?
Yes, I am,
All right. So,
and I have no other income.
all right. So how much is your Social Security?
$2,200 a month.
Okay. All right. Chris, you talk.
I believe it's around $800 a month because you're on disability before they would start looking at it and taking back Social Security because
All right. He's got about 26,000 in Social Security a year, right? So half of that is 13,000. So
right. But how old are you?
no, but he wants
64.
Okay. Oh, so it's regular.
right,
Okay.
Yeah.
No,
But-
it's not regular. It is.
Well,
Social
it's
Security.
disability, but I'm thinking you are younger, and so then you're looking 14.3 or 15.3. It's up now to 15.3 before you reach 66, before you have to pay back.
Are you
the debt.
talking about paying it back, or how much is before it's taxable?
I want to know how much before it becomes taxable.
Yeah, that's what I
Okay.
thought. All right, so 13,000, half of your 26 is 13, gets added, and so if you make another $12,000 in wages, that would put you at the $25,000 threshold. So you can make if you can make $12,000 before any of your Social Security becomes taxable.
Okay, that's what I needed to know.
Okay,
Thank you very much.
you're
Have a
welcome.
great
Rich.
Easter.
Thank you. Bye bye.
And don't forget to add in all your other income to that figure too, to back off.
He said that was all you had.
Okay, well, I'm just saying,
Yeah, I
just
know.
in
That's-
case,
but
because
that's-
some people say this is all I have, and then they have others.
That's true. But
So,
But
yes.
I can only go on
what they say.
That's right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And I'm going to sneak in a quick call here. Hi, Amy. How can we help you?
I thank you for taking my call. I'm asking advice on a couple living together, not married.
Uh-huh.
They had a baby 4 years ago, and the father is claiming the baby, filing head of household.
Uh-huh.
Now they had another child. Can the mother
No.
claim as head of household?
No.
You can't.
No, there's one head of household.
Okay.
If they're living together in a household, the person with the higher income is the one that, if it's their child, would be the head of the household. Now she can claim the baby on her own return. No, actually, they're living together, so
They could
split the child.
They can split the children.
So they can both, but only one head of household.
Thank
Okay.
you very much.
Thank you, dear. Happy Easter. Bye-bye. I'm Esther Golias, the tax lady. We're going to take a short break for news. We'll see you on the other side. Hop online, 8030930, 8030930, star 930 on a cell phone. See you in a minute. I like that one, too. I should have my husband listen to this, then he would know what the Stones have.
I don't know what they are saying.
Not my husband. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on his cell phone. 1-800-616-9236 in Canada, Florida, Arizona. And we want to help you. And let's face it, there's 11 days till the big day.
Or Georgia, if you're Larry.
Or if you're Larry. All right, we're gonna go to the phones, but I want to talk some more about your brokerage statements. Now, obviously, the sales of stock are not necessarily obvious when you're looking at your brokerage statement. Many times they have the interest and the dividends on page 1, and you kind of have to flip it over to find out if you sold any stock. Now, even though you think you didn't sell stock, if it says that there was what's another word for the
proceeds?
Proceeds. If there's proceeds, you sold stock, and even though you don't think you sold stock, that went to the IRS, and you have to deal with it. There are probably the biggest thing that we see in the summertime with letters is people that don't report the sale of their stocks.
Yep. Oh, definitely. And that's exactly the same. I didn't do it, but your broker restructured your account.
Right. Now, what you're going to find is that there's codes. There's a code A, and that means it's a covered stock short term, which means that the broker knows what the basis in the stock is, and they're providing it for you, and they're letting the IRS know. Then there's a short term uncovered, which means that they're not letting the IRS know, but they're usually providing the basis on the stock.
Yep.
Then there's a long-term sale covered, and that's a D. And then there's a long-term sale not covered, and that's an E.
Yep.
And if nobody knows, it's an X. But now here's the thing. I just had a client this morning that we did it in there, and they had an uncovered long-term, and he was just going to let it go. And if you let it go, you're going to pay the taxes on it, because if they sold $20,000 worth of stock and the broker didn't know the basis, you want to make sure you go through your records or call the broker and say, hey, Jack, help me with this, because otherwise you're going to pay the taxes on it, and it can be a lot of money.
Yep. Definitely.
Right. So that's part of what's on your brokerage statement. And by the way, the other thing that's on your brokerage statement is fees that you paid in margin interest, which would be deductible if you're an itemizer, right?
Yep.
And fees that you paid for your broker.
Correct. One goes under the interest paid, like your mortgage, and the other one goes down to miscellaneous, subject to 2%.
Right. And those are just some of the things that are on your brokerage statement. So, and if you have questions after tax season, you want to come in, we're happy to sit down and go over it with you, so that you would be an educated consumer. All right, we're going to go. Then, Mike, how you doing? How can we help you?
All right, hi. Thanks for taking my call. I guess I got a plethora of questions, but to begin with, I file head of household, and my girlfriend and I have a biological child, which I'm going to claim. She also has a child from a previous relationship whom she'd like to claim. I understand that she can. Do you have any idea of what it would benefit if I did or she did?
All right. So if you have a child together and you're the major breadwinner in the household, you claim the child and the head of household status. She, if you're single, has a child that you really can't get the earned income credit for. How much do you make, Mike?
I'm at about 60, and she just started working. She only worked for 2 weeks in December and made about $1,500.
Okay, so she would
and we all, we do live together. We're going on 3 years living together.
Okay,
so previous 2 years she claimed her daughter.
All right, so she would get an earned income credit for the child that is not your child. Would be a very small earned income credit, but with you making income about $60,000, being head of the household, you're in the probably 25% bracket. You'd really have to work it out and see if she makes more money claiming the getting the earned income credit and claiming the child, because she has no tax liability. The only thing she's going to get is the earned income credit.
Correct. And that, $1,500, one child, I'm going to say probably about $400 would be her benefit. Esther's looking it up.
All right. She gets an earned income credit of $519. All right. $519. She won't get the refundable child tax credit, of course, but he would get. It's not his child.
Right, but he would get 2 dependents, which would save him
only one earned income credit.
Right, but he would still save
$1,200. You're going to do better, Mike, claiming the child.
Claiming both of them, actually.
Right, claiming her child as a dependent, but it's not your qualifying child.
Even her.
And
you can claim her too.
Now let me ask you this: one more snafu. What about her and her student loans? Like she claimed her daughter on when she got them.
Mike,
financial aid and whatnot.
she has no tax liability. So the only reason she'd file on her own is to get the $519 on the federal,
Okay.
and she'd get another couple $100 on the state. So she's got $700 to get. Now this is what you would get, though. You would get she is a dependent. Her child is a dependent. It isn't a qualifying child, so you can't get you wouldn't be able to get the earned income credit for it anyway because his income's too high. But he then would get. You would then have the child tax credit,
Right.
And you'd get the child tax credit on the state too. So you would benefit much more than she would benefit. Now next year it's probably completely different because at that point in time she'll have a full year's salary. But you can't claim her student loans because you didn't. It's not your student loan. But
Right,
you will
okay.
definitely do better. Now, she may not like it that you're going to get all the money, and to make her feel better, you might want to deposit separately into her bank account the money that would have gone to her had she filed on her own, and then you get the rest.
Gotcha.
Okay?
Okay. All right. Thank you.
All right, thanks, Mike. That's an interesting thing. Okay, let's see. We got Tony. Hey, Tony, how can we help you?
Yes, Esther, I'm not sure if you are aware of it, but when your friend of mine was on disability and he wanted to take a job that would earn him a certain amount of money, he went to Social Security, and they told him that he is allowed a 9-month trial work period.
No. With that other guy, no, but Tony, that guy wanted to know when it was going to be taxable. But you're absolutely right. I know they'll let you work it out. If you're
Right. But the point is if you're on disability and earn more than the allowed amount in a month, a trial work month, you can, after 9 months, they can take you out off this Social Security disability.
And that's correct too.
But he was Tony. He was 64. He could have gotten regular Social
Right,
Security
but he was
then
getting
too.
a larger kicker.
Probably, but
that's
still.
true. But you are absolutely right, Tony. And but he was asking whether it was taxable. But you're absolutely right. And I thank you for your call. And we're going to go to, let's see, who do we have here? My next caller, Gene. Hey, Gene, how can we help you?
Yeah, hi, Esther. I've got 2 questions for you.
Okay.
The first one has to do with charitable contribution. Let me give a 30-second background here. My wife reviews children's literature and writes articles on that, and as a result, publishers send her hundreds of books. During the course of the year, we quite often package them up and donate them to different places. The question is that a charitable contribution that can be deducted?
All right. When you do your charitable deductions, non-cash, it asks you what your basis is in the thing that you're donating. Since there is no basis in there, it's the fair market value or the cost, whichever is lower. So she would have no basis.
Okay. She has no basis, so they are not deductible.
Well, they're deductible, but you're not. It's only whatever she's got into the book. So if she shipped it back, if she paid postage, if she had it bound, that would be a cost. But if they're giving it to her for free, then there is no basis, so there'd be no deduction.
Okay, and it is strictly basis. It's not cost or basis.
It's cost or basis, whichever's lower.
Okay. All right. The other one has to do with Social Security. My wife's turning 62 this year, and I'm still working and going to continue working for a couple years. So our income will be too high. But when they reduce Social Security because of the income, is it family income or is it just her income?
Just her wages.
Oh, excellent.
Her wages. So she can, I think it's $15,500 this year. So she can make $15,500 without having to pay back any of the Social Security.
Perfect.
Okay.
That helps a lot.
All right. Thanks, Gene.
Thank you. Bye-bye.
Happy Easter. Thanks.
And he may want to look into if his income's high, they may want to look into doing withholding out of her Social Security.
Because a lot of people wait until they're doing the return and then they say, "Oh, how come I don't get a refund anymore?" Because you started getting Social Security. It's taxable. Yes, it can be taxable up to 85%.
Yep.
So that can be a real shocker. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. Out of town, it's 1-800-616-9236. We got 11 days till until Uncle Sam comes a-calling, and we're going to go back to the phones, and we're going to talk to Elizabeth. Hey, Elizabeth, how can we help you?
Hi. My husband was laid off from his company for 3 years, and there was a vote and things happened during that time, and he was working for another place. Now, I started getting 401k information in the mail, and I thought it was just junk mail. And what happened when he was laid off, they took pay cuts for the next 5 years, that contract, and the upcoming 5 years. So they deduct so much out of each paycheck, the union does. And they have this 401k plan set up. And so they sent me letters and information, and then my husband at work signed the form that he had it put into the lump sum into our checking account with direct deposit with his regular pay.
All right, so let's see if I got this right. Your husband took a distribution on his 401k plan, correct? You didn't know he was, but he did. He did it inadvertently?
Yeah, just this week, just this paycheck he got this week. He got 2 paychecks.
All right. Did he get all of his 401k money?
I think so.
All right. So, if your husband took a total distribution, and I know you can hear me in the background, it might be confusing to you. Do you want to turn off the radio? Are you good? You're good.
Radio.
Okay, all right. So if your husband inadvertently took a distribution, the total distribution from his 401k plan because they canceled the plan, he has 60 days to roll it over into an IRA so it isn't taxable.
That's what I thought.
All right, so you want to make sure that you find a financial institution that you think is worthy of holding your IRA. And so you just march down there with that 401k distribution and you open up an IRA, and if it's done within 60 days, then it won't be taxable. So his employer is going to send a 1099-R form saying that it was distributed, but then you have the ability to make it not taxable if you fulfill the rollover requirement within 60 days.
They taxed it already.
Okay, so you to make it fully tax-free, if you have the extra money that equals the taxes that they took out, and you can roll over the whole thing, then the whole thing is going to be tax-free next year. If they did take out the taxes and you roll over everything but the taxes, then only that little bit that was the taxes is going to be taxable, and you'll get a credit for the taxes that was withheld next year.
Now, I have Evans deal with Evans Bank. Is a CD considered
it's not.
IRA?
You can open up an IRA and put it into a CD.
It can be a CD IRA, but not just a CD. In other words, it's got to be called an IRA. Now, the vehicle that the IRA invests in can be a CD, but it's got to be in an IRA.
Okay, because we have just a small IRA, Roth.
Don't put it in a Roth if you want it tax-free, because if you roll it over into a Roth, it's going to be fully taxable. So what you want to do, believe me, when you go to the bank, they're going to know what you're talking about.
Okay.
So it's got to go into a traditional IRA.
Okay.
If you want it tax-free. If you want to pay taxes on it and roll it into a Roth, that's up to you, but I'm going to tell you you'll be a little shocked next year.
Because
you're going to pay tax on all of it.
On all of it.
We lost principal on the Roth IRA, and
Well,
I was one. Are we going to lose any principal on this?
In any investment that you put your money into, Elizabeth, you can lose principal unless it's in a CD. Okay, I mean that's just the nature of the beast. When you go into an investment and it's anything other than a guaranteed investment, such as a CD, your principal can be lost. It has nothing to do with whether it's a traditional or a Roth IRA. It's just the vehicle they put it into. So I think what you need to do is talk to your investment advisor about that, number one.
We don't have one. We don't have an investment advisor.
Yeah, well, I would go to Evans Bank and ask to talk to their financial person.
Right.
Okay.
You know, and there's, if you want to call our office, we'd be very happy to give you several names of investment advisors that we like to work with, or Next Financials, our partners here just before us. You can give them a call, but I will tell you, you have 60 days. The clock is ticking if you don't want that to be taxable. Okay.
Okay, and so and what you're saying is there's no way to have a CD be an IRA?
No, you can, but you have to get an IRA and then invest it in a CD.
That's right. It's first an IRA, secondly a CD. Okay?
I don't know.
Well, here,
Elizabeth,
Elizabeth, call 633-1515. That's the guys on the radio before us. I'll call them on Monday.
Call them on Monday, and they'll help you too, okay?
And they got an office out in Hamburg, okay?
633-1515.
1515.
All right, thank you very much.
Thanks, Elizabeth. Bye-bye. I didn't want to give her the bum's rush, but
yep.
But that's what happens sometimes is you aren't aware that the company's terminating a policy and they just send you the money.
Yep.
And you don't want the money sent. All right, we're going to go back to the phones. Hey, Wayne, how you doing? Hello, Wayne.
Hey, how you doing?
Good.
Thanks for taking my call.
Yeah.
This never came up before. Me and my wife filed jointly, and my wife was injured at work last year, and she's been out on workman's compensation. I was just curious if I got to declare that, and is it taxable, either state or federal?
Well, she's on workman's comp?
Yeah.
Totally tax-free.
Okay, so do I still got to, because we're going to get our taxes done, do I still got to tell the preparer that?
No.
Nope.
It's tax-free.
It doesn't go anywhere on the return. If they ask if you have any other income, say, yeah, it's workman's comp, but workman's comp is tax-free.
All right, I appreciate the call. Enjoy the holiday, all right?
Thank you, Wayne.
All right, have a nice day.
Bye.
Bye.
Thank you. I'm Esther Gulius, the tax lady from EG Tax. Our offices are open, and we will help you 9 to 9 Monday through Friday, 9 to 5 on Saturday. All right, now we're going back to talk about things that people don't know about their brokerage account. Sales to related parties. Now, I had somebody the other day that said to me, I'd like to take my stock that's lost money, $5,000, and sell it to my brother. And then my brother is going to sell it at a loss. And no, if I sell it to my brother at a loss, can I take it?
Nope.
No.
Nope.
Because sales to related parties is not a deduction. What happens is the basis of the stock basically goes to the brother, and then when the brother sells
he gets the loss.
Yep. Right?
Yep.
So that's one thing people
the
aren't aware
arm's length, that's what's called the arm's length transaction.
Because really, when you think about it, people can manipulate,
Yep.
right? You and your brother ought to be good enough friends that you can play that game, but that's why it's not deductible. Deceased spouse's loss carry forward. If, let's say, you're a husband and wife and you have $50,000 in, let's say your husband had stock, $50,000 loss carry forward. He's carrying it forward every year. Then he passes away, and the wife is now filing a tax return. That loss doesn't go to her.
It's gone.
When he passes away, the loss is gone. However, if it was jointly held, then she'd be able to get half of it.
Yep.
Right?
Yes.
So that's another thing people don't know. And then the other thing is when you sell depreciable property. When you sell depreciable property, that's another form of potential capital asset, but you have to do something special with the depreciation. All the depreciation that you had taken over the years has to be accounted for in the year of sale.
Yep. So you buy a house for $80,000 and you wrote it, 40 years later you want to sell it. That house is fully written off. So whatever you sell it for,
if it was rental property,
would be basically all taxable, depending on any other improvements. But I'm just saying, just that house in general would be all taxable on your tax return.
I'm doing a tax return right now with the gentleman who just sold a house, and he said to me, "Well, this was gifted to me by my mother, and so it was worth $150,000 when she gave it to me." And so I said, "But what did Mom pay for the house?" And he says, No, it was worth $100,000. But that's not true. If you are gifted a house, then it goes back to the basis of what the donor had. And so in this particular situation, it had already been depreciated a number of years. So the depreciation starts at the lower basis. And now he sold it, and he's got a very large capital gain.
Very large.
Right?
And he's probably not going to be very happy.
Actually, I don't think he is. Another thing that people can do, though, if you're selling property like that, you can hold the mortgage.
Yep.
And that's called an installment
sale. Or I had one, how about move into that house? Sell the house you're in. If you don't mind moving into that other house for 2 years, then you could sell it. It was your primary residence 2 out of the last 5, and then it's tax-free.
That would be correct. Now, the 6252 will help you. But anyway, all right, I can see I'm running short on time. I'm Esther Gulius, the tax lady. If you have any questions during the week, if you have a tax situation, if you've been getting a letter, and by the way, if you get letters from New York State, don't believe half of what's in there. Most of them are all wrong. You can use EG Tax as a resource. We want to help you. Our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Until next week, I'm Esther Gulius, the tax lady, and Christopher Fabian. We'll see you. Thanks for listening. Have a great week, and happy Easter.